This is professional investor David Campbell, and I am very grateful that all of you took a little time out of your day to spend with me learning how to prepare for your financial future. Most of you know who I am, and for the very small number of you who don't know me, I've been a principal or a key advisor in over $800 million of real estate transactions involving apartments, office, medical office, retail, hospitality, winery, condo conversion, production, home building. I've done a lot of real estate, but when I started out as a full-time high school and college band director, and I did real estate part-time, and it was a very interesting growth curve. You know, I started with really no resources other than my sweat equity and put together a multi-million-dollar real estate portfolio. And before the age of 30, I was a multi-millionaire, and then I lost it all in a pretty substantial real estate collapse in California in 2007, 2008. That was a very hard time for me. But the first million's the hardest. You know, once you've made $1 million, you have that skill set. You know that you can do it. And, you know, I did it once with no resources, and I did it again with no resources. And the second time was much, much easier and faster. So if you're in your aggregation mode, if you're putting together your resources, really, you are why I exist. Helping other people live more abundant lives by giving you the knowledge and resources you need to be not only a successful investor, but to invest with mental tranquility is really why our company exists. And so I'm happy to be here to help you. A big disclaimer, this event is education only, and there's nothing for sale. You know, the only thing that is for sale is really just a relationship with me. You know, at the end I'm going to ask, would you like to schedule a call to talk about your personal situation? That's the big close. So let's get that out of the way up front so you're not looking for the pitch. There's no books for sale. There's no tapes for sale. There's no training. It's just really, if you're looking at investing, I'd love to be a part of your investment team. Today's topic is, we're talking about currency devaluation. That's a fancy name for inflation, or you could call it QE1 or QE2, whatever you want to call it, but it's really a hidden tax. We're going to talk about why it's happening to you, what you can do about it. We're going to talk about why the global recession will get worse and what investments you absolutely want to avoid and how to leverage these interesting times to your profitable advantage. There are a lot of people that put out some political commentary and say, oh, it's so terrible, times are bad, but they don't tell you what to do about it. So I'm just going to skip over all of the doom and gloom because you already know it's doom and gloom, or you probably wouldn't be here. But we're really going to focus on the practical and the tactile, which is how do you make lemonade out of the situation. The first thing is, here's a picture of a car. And if we were exchanging value, you could say, well, this car is worth so many bushels of wheat or so many barrels of oil or so many whatever, right? As soon as we put a currency on something, how much is this car worth? Is it worth 10 grand? Is it worth 20 grand? Is it worth 30 grand? Is it worth 40 grand? There is someone on earth who would pay each of these prices. And the value is what it is, but the price, when we start denominating things in dollars, then we get price confusion. For example, gasoline has pretty much a universal function. You put it in your car and your car goes. But the price of gas, it changes. It changes day to day. That's why they have those signs that are flexible. It didn't get more expensive or more difficult to produce the gas. What's happening is, in a small sense, you get fluctuations of supply and demand, but in a much, much more bigger sense, we have fluctuations in our currency. So there's something happening inside of our currency. We have a fiat currency or a fake currency that's making the price of things change, and it's usually going up. Not always going up, but usually. When we are looking at making smart decisions in our economy, really look at exchanging value, not price. Because, for example, we might agree that this house could be worth 6 cars, right? That could be an interesting exchange of value. Some people see the price go up and they get excited. They think they made a profit. Some people see the price go down and they get sad and they think they lost money. And really, that's kind of true, and we're going to talk about when that's to your benefit to have price fluctuations and when it's really just a fluctuation in value. because as an investor, we can use price fluctuations to our advantage, but ultimately what we want is using currency as another medium of exchange, right? And so we're going to take a little poll here. How concerned are you about rising inflation? You think we're going to have double-digit inflation over the next 10 years? Are we looking at some modest inflation, or do you think we're headed into very low periods of inflation? It looks like 71% of you think we're having double-digit inflation over the next 10 years, and 30% of you are thinking we're going to have 5 to 10% of inflation, but no one on today's call thinks that we're going to have less than 5% per year inflation. Well, the federal government is targeting about a 3% inflation rate, and we all on the call today think that the Fed is not going to really hit that particular target. So really, what are we going to do about it? So democracy is wonderful. There's a lot of great things about democracy. The great Winston Churchill says, democracy is the unequal sharing of blessings, and communism is the equal sharing of misery. So we all know that democracy isn't perfect, right? And when someone invents something better, a better system of government than democracy, then let's go embrace that. But I haven't seen that world around. But one of the big vices of democracy is it's a political popularity contest. The people that are in power want to stay in power, and in order to stay in power, they have to be popular. And the cost of government, the true cost of government, is not a popular thing. You know, it used to be that if you were going to have a war, you would pass a tax to pay for the war. But it became pretty obvious that if you went to the people and they had to pay for the things and pay for the policies that you implemented, and they saw a direct correlation between their tax bill and what your policies were, people got a lot more involved in their government. They got a lot more vocal, and they had more opinions about who should be in and who should be out. But what's happening now is the government has created a way to hide the true cost of government, and they do that in 3 ways. They do it through taxes, printing, and velocity. And those aren't really the things maybe that you're thinking they are. Let's take a step back and look at some history. So the Vietnam War was a very long, almost a 20-year war. And towards the end of the war, the American government realized that they were running out of the resources to pay for that war. And at the beginning of the war, we had a sound currency. Our currency was tied to gold. So we couldn't crank up the printing press. For every dollar that was in circulation, we had to have a dollar of gold somewhere on the American balance sheet. And towards the end of the Vietnam War, more and more and more people protested. And when you hear about the Vietnam War protests, you don't hear about protests from the 50s. You hear about it from the late 60s, because it was not until the end of the war, when people were realizing that it was affecting their pocketbook in America, that they said, hey, what's going on? All this, our economy is sucking, and I'm paying these high taxes, and where's it going? Oh my goodness, there's a moral atrocity happening across the globe. Now let's pay attention. And so what's happening now in our world is there are global atrocities happening all over at the as a result of our government meddling in foreign affairs, and the American people don't see a direct cost of it. And so you don't see the war protesters protesting our current war like you did in the 60s, because our currency is corrupt, and our government is playing a shell game behind paying for the war. We don't have a war tax stamp that you put on your postage. The government's found a different way to pay for it. And when the government has an unlimited spending through the printing press, then they have unlimited power. Only until the party's over. For once the currency catches up and the American people realize that what we've got is a shell game, then the people start to get smart. So let's talk about what that shell game is and how our government is using that shell game to swindle people really into giving the government unlimited power. So the government doesn't need to collect taxes. Let's just be clear. The government does not need to have you send them an income tax check or a sales tax check or a property tax check ever. The government has the printing press. They can print all of the money they will ever need to run the federal government. So you say, well, David, that's kind of silly. Why would we have taxes if the government can just print the money to pay its bills? Aha! It's the shell game. People think that they're paying taxes to pay for our government, and they cry out, we need a balanced budget, we need to have sound economic policies, let's not spend more than we collect in taxes. Well, what the taxing is doing is it reduces the supply of currency. Printing presses increase the supply of currency, taxes reduce the supply of currency. The federal government takes that currency out of circulation so that it can't be spent. All right, so that's the first way that the government controls inflation is through taxes. Trust me, the government doesn't need your tax bill. They need you to not spend those dollars on other goods and services, because if you had that money in your pocket, it would create that hyperinflation situation that we were talking about. So when you write that tax bill this April, realize it's not to pay for government, it's to eliminate currency from circulation, which reduces inflation. Printing, once the money is printed, the government can't take it out except through taxes, right? So one thing in my crystal ball, everyone makes forecasts, and all forecasts have an element of truth and an element of error. And my forecast is the government is going to increase printing. They're going to increase the velocity at which they print that money, and in order to slow inflation, they have to raise taxes. Because when the government prints the money, they get to spend it first, and it goes to the things that the government wants. Then, in order to prevent hyperinflation, they raise taxes to pull that money back out of circulation. There's other things that taxes do, such as stimulate certain things that the government wants. For example, real estate is a very tax-favored asset, and so there's a lot of tax laws that go to stimulate people to own and operate rental properties. And that's one way for the government to stimulate that activity is through taxes. It redirects the money from people not investing in real estate, and it gives that money to the people who are investing in real estate as an incentive. Velocity is a very interesting thing. When you read, oh my gosh, the economy's terrible, nobody's spending, well then you don't spend. You hoard the money, and when you hoard the money, it reduces the rate of inflation. So the government can say, inflation rate's low, we can print more and spend more. Because the government needs to keep inflation in check in order to keep the shell game going. Once inflation becomes hyperinflation, then that's when the currency collapses and we have to start over. So the government has an agenda to feed the media negative consumer confidence information when they think they need inflation to be in check, and they need to feed positive consumer information when they want to stimulate the economy because of an upcoming election, or they think that inflation is a little bit too low. So when you're watching the evening news and you're reading the newspaper, almost always the information that you're getting from mainstream media is probably 100% opposite. Because if the government wants to say, things are doing great, let's print all this positive news about the economy, what they're really trying to do is stimulate inflation because the economy isn't good. They need additional velocity to happen, people to go out and spend their money to increase jobs, right? Let's take a step back and let's say when the economy says, the economy's terrible, it's terrible, nobody's spending, nobody's spending. Well, probably what that means is the government needs to go spend some money, and they need to spend trillions of dollars. And if they spend the money at the same time that you spend the money, there's going to be a problem. And so the government needs to take you out of the buying pool for a while so that they can use their fake currency to go buy. So one thing as an investor is really take the media news with a grain of salt. There could be truth in it, but there is oftentimes a lot of spin that's actually the opposite of what's really happening. So do you say at this point, David, what do I do? You've got me confused. The up is down, left is right, and what do I do? Well, the first thing is don't panic. we have been here before over and over and over again. All you have to do is Google, not now, but when some other time, Google hyperinflation. You'll get a Wikipedia article, and it'll show you the hundreds of times in global history where we've had hyperinflation and a total collapse of a currency, and the world didn't end, right? So the end of the U.S. dollar is not the end of the world. For example, there used to be the German mark was one of the strongest currencies in the world. It used to be as strong as the dollar. You don't use German marks anymore, and that happened within our lifetime. Don't panic. We've been here before. We've had the Confederate dollar. That went to zero. We had the Continental dollar. That went to zero. I mean, there's several times where the U.S. dollar was completely devalued. You know, we're a very young country, and to have, you know, been on our third round of currency, really our fourth, because if you look at the gold standard as a currency, those were gold reserve notes, and we transitioned into a fiat currency. So anyway, the Romans, the empire, had their currency collapse. Life goes on, so don't get too stressed about it. But there are certain things that you can do to mitigate the pain when we go through this transition. When we go through a transition where your currency, you feel like it has value today, and tomorrow it has less value and less and less and less. And if you prepare wisely for it, you can use inflation to your advantage. And that's a very dangerous thing to say, because I think inflation is inherently evil. Fiat currency is inherently evil. It's a shell game, and the majority of people using our currency don't know what's going on, so the government is manipulating people's ignorance, and the government system of education deliberately doesn't teach people about our money system because the government doesn't want you to know. If you realized it was a big shell game, there would be problems. So when you're holding cash investments, be very careful, because your cash becomes less and less valuable over time. It buys less and less stuff. You need enough cash to pay your bills and to have a reserve for a gap in employment, but any more than that, and your paper could be a potential liability. Number two, don't buy bonds. I'm not saying be wise about buying bonds, be careful about buying bonds. No, absolutely, on no uncertain terms should you buy a bond. Absolutely not. So let's take a look at why. The way, if you're going to hold a bond to maturity, if you buy a 10-year treasury, you hold it for 10 years, very likely, you know, your interest rate is not outpacing inflation. So you've guaranteed yourself a loss. The other thing is, if you decide to sell your bond at some point in the future, the bond has a value that changes every day. Some people think, well, I have a bond and the face value is $1,000, so I can turn this into the bank and get $1,000. That is not true. Sometimes you could turn your $1,000 bond in and it might be worth $1,500. Sometimes you could turn your $1,000 bond in and it might be worth $800. It really depends upon how long till maturity and what the interest rate is on your bond. Right now, here's about a 100-year history of bond prices in the 10-year Treasury in the United States. Today's 10-year Treasury rate is about 1.8%. And that's the lowest it's been in a 100-year history of the United States. If interest rates go down, the price of your bond will go up. If the rate goes up, the price of your bond will go down. So looking at this chart, how many of you think, I wish I had a poll created for this, but I don't. So how many of you think, because the answer is obvious, how many of you think that bond prices are going up? Well, over the last 100 years, they've always been higher than today. So the last 100-year data shows that probably they're low relative to time. How many of you think bond prices are going down? Nobody, right? This is as low as they've gotten, and they're not going to go lower because they can't go lower than zero. So the betting man would say bond prices are going up, which means you would be losing value. So if you buy a bond today, you will lose on your investment because the interest rates have to go up. Get fixed interest rate mortgages. Going back to that last chart on 100 years of interest rates, we're at the lowest interest rates we've had in 100 years, and maybe even longer. I just couldn't find data older than that. So these are the lowest interest rates in our lifetimes. You want to borrow as much of that debt as you can. For example, if you borrowed at 5% and you invested at 7%, you're making a 2% profit. That's called positive arbitrage. If you borrowed at 7 and you invested at 5, that's a 2% loss. That's called negative arbitrage. So one great thing as an investor is if you can go borrow and lock in your long-term cost of funds, that's a great asset for you long-term. The other thing is arbitrage confusion. I had an investor consultation with a client this week, and they had an adjustable rate home equity line of credit, and they wanted to borrow against that home equity line of credit to go invest. And they said, look, my HELOC's at 2%, and I can borrow it at 2%, and I can go make a hard money loan at 10%. I can make an 8% arbitrage spread. Let me go pull out all my money and arbitrage and make an 8% spread. Well, that's good if you could lock your interest rate in at 2 and you could invest it at 10, or worst case, if the investment drops below whatever your fixed cost of borrowing is, well, you pay off the loan, right? You never want to be in negative arbitrage. So if you become negative arbitrage, you pay off your debt. So arbitrage confusion is when you don't know what future interest rates are going to be. I can tell you the future interest rates, my crystal ball is not perfect, but it's pretty good on this one point. Interest rates are going up. I don't know when, I don't know how much, but I know they're going up. I don't think they're going up anytime soon. I think we've got a nice stable interest rate environment through the presidential election, and then all bets are off. So right now, if you're looking at investing, you have to lock in your cost of funds so that you know what to invest at, right? And until you know the cost of borrowing, you don't know really where to invest. Bullet point number 4 is invest in durable goods or commodities other than money, right? If you can invest in something that isn't dollar denominated, that it has intrinsic value. I like real estate because it has intrinsic value. Other people like gold because it has intrinsic value. You know, I would love it if I could go buy 1,000 gallons of gasoline and stick it under my house. I think that would be a great investment. The challenge is gasoline goes bad. You can't hold it for years and years and years because it's not durable. The other thing is it's dangerous. You know, I need a lot of specialized equipment to store that kind of a commodity. So whatever it is that you've got, I especially like commodities that you can lease. And man, if you can tell me of a commodity that will hold its value, keep pace with inflation, that you can borrow money to purchase it, and you can rent it out for income in the meantime, let me know. I want to buy that. You know, I am very exposed in real estate. I got a lot of real estate, and I can't find anything else to buy that meets all those criteria. So if you can think of one, you know, send me a jingle. I'm a smart guy, and I'm still looking. Bullet point 5, invest in things that people will use in any economy. So when in any economy, we need to exchange value for value. And so if you're looking at needing to hold your currency as the medium of exchange, you're going to get burned because the government can rob the currency that's in your bank account. They can rob the bills that are in your safe. They can't take away the intrinsic value that's in something durable like a car, in something durable like a house, something durable like a piece of equipment for your business. Those are things that have intrinsic value that you can exchange for the things that you need at some point in the future. I really like investing in things that people need in every economy, such as medical office. You know, when I'm looking at what types of real estate that I want to own, I really like medical because in good times or in bad times, people are going to go to the doctor. I also really like low-end retail. I like Family Dollar. I like Dollar General. I like Walmart to a certain extent, but the difference, say, between Family Dollar, Dollar General, and Walmart negotiates with their suppliers to provide very, very low pricing based on their volume, and Walmart buys the majority of their products that they sell, they buy them overseas. And with the price of oil going up, that makes it more expensive to import. With our currency growing weaker against other currencies, that makes it more expensive for us to import goods. So Walmart is a great market leader now, but I'm a little concerned about their future because they can't import things cheaply and they'll lose their market position. Someone like Family Dollar, Dollar General, 99-cent store, Goodwill, they tend to buy surplus. So they're not negotiating with the manufacturer as much as they are negotiating with the clearance centers. You know, if someone went to an A distribution channel and they couldn't sell it, well, they mark it down and they send it to Family Dollar, Dollar General to liquidate. Also, we're looking at competition. You know, Walmart sells things, the same things that Amazon sells, and I would rather stay at home and buy it on Amazon because it's the same price and I don't have to go to Walmart. Or, you know, I've got better choices on the internet, whatever the reason you shop on the internet. But with the price of shipping going up because of oil, it becomes less and less advantageous to shop on the internet. And so the people who are minimum wage, which is a lot of people shifting to that lower part of the socioeconomic demographic, those people have to buy local. They're going to walk to their local Family Dollar or Dollar General or whatever that low-end retail is to buy their necessities. And so that's another asset that I really like. I also really like modest housing, you know, because people will let their house get foreclosed upon, but they're not going to go sleep in the street. They're going to prioritize having a roof over their head and warmth. And so housing is definitely a great place that's going to be resilient in the economy. It has durable, it's a durable resource that people need and will prioritize the exchange of resources for. Not luxury housing. I don't see that that's where our demographics are heading. I think things are headed towards the low end. Personally, I don't like the low end because you've got management problems and you've got the lowest end of the economy is dependent upon the government to live. So if your tenants are all on government assistance, I think you're fine in the midterm because I think our government has the printing press and they're going to keep printing money to pay for those tenants. But if we have, you know, some type of Armageddon event at, you know, a governmental level, then the people in the lowest income housing, that's going to be a management challenge because those people don't have money to pay you rent. They're going to just squat on your property, and that's problematic. I don't know that we're going to have a, you know, some type of a major social unrest because of our currency. I think it's a possibility, but I wouldn't really, you know, invest in that direction. But I really like, you know, that lower middle class, or shall we say the top end of the low income, because those people are working class people that pay their rent. I also like resource-rich areas. I'm a huge fan of Texas. I think they have got a great government system. I like that they are a resource economy. They have oil and natural gas. Those are two different energy resources that our country uses. They are also one of the country's largest producers of wind energy. And so you look at how strong the Canadian currency is now, and you look at how strong the Canadian economy is relative to the rest of the world, Canada's doing pretty good because they export minerals and they export energy from their country. And that's a great resource for them. And so I would gravitate my investments towards areas that benefit from energy-rich areas. I would like to invest for long-term capital gains and avoid short-term investments that give deceptive sense of making profits. Let's talk about that. So let's say you went out and you bought IBM stock at 10 and you sold it for 15. Woohoo! Jump for joy! I made a 50% profit. It doesn't matter the time frame, right? Let's just say it was in 1 day or 1 year or 10 years. It doesn't matter. I bought it for 10 and I sold it for 15. I made a profit. Who's excited, right? Well, let's take a look at that. So let's say you bought your stock and it was 2,000 shares and that was $20,000, and you sold your shares and you got $30,000, but the price of a car went from $20,000 to $30,000. You didn't really improve in your value exchange, right? You started with the car, you ended with the car. But here's where the problem is. Because you went through what's called the cash step, you went from asset to cash back to asset. Every time you make that cash step, you have to pay the tax man. So you bought IBM stock at $20,000, you sold it at $30,000, you made a $10,000 profit. The government wants their 25%. You made a net $7,500 profit. You're still excited because you made a profit. Your net cash available is $27,500, but the car went from $20,000 to $30,000. You started with the car when you bought the stock, and after you paid your taxes, you can't buy that same car again. So you made a paper profit and you made an actual loss. And so be very careful about perceived short-term capital gains and whether you're really making money or not. The other things that I really like are long-term ownership of property where the expenses are paid by the tenant. So if I can get into a relationship with a property where it's a triple net lease, triple net means the tenant pays the taxes, the insurance, and the maintenance. So if taxes, insurance, and maintenance go up, I don't care because my tenant pays them. And if you can then get the rent to be indexed to inflation, it's the perfect storm because as prices go up, your tenant picks up those costs, and as the whole basket of goods goes up, your rent goes up to keep pace. And my favorite part is the use of leverage in purchasing this durable commodity. Is, for example, if you borrowed $500,000 to buy this store and a car was $25,000, well, you paid, you know, the equivalent of 20, you've borrowed the equivalent of 20 cars to pay off that mortgage. Let's say you had an interest-only mortgage. It doesn't exist, but let's just pretend for education's sake, an interest-only mortgage on this commercial property, and you held the property for a period of time, and the mortgage stayed the same, but a car went up to $50,000 because of inflation. The mortgage can be paid off with 10 cars. That's a win. You can really make a real profit in that scenario, even though the numbers didn't change, right? It's still 500, but the price of a car doubled, so your mortgage was cut in half. Very important to learn about bartering. I do a lot of bartering. I love skipping the cash step. I avoid transaction costs that way. And I don't necessarily avoid taxation because barter, you do pay income tax on your barter, but it gives you a little bit of subjectivity in when you're bartering. You know, if you've got 2 sheep and I have a cow and we want to trade, well, maybe there's a taxable event in there for me, but how do you pinpoint the value of 2 sheep and a cow when we trade? It's very subjective, and so that could be an assist to your tax situation. It's also a great way, for example, in my business, I've got some very key employees that work for us, and I was able to pay them not with cash, but with real estate. I was able to say, look, I've got this property here with equity in it, and I could sell it and use the cash and pay your salary, but I'm going to pay a lot in transaction costs. You're going to want to use that salary to buy real estate anyway. Let's just barter, right? You give me your services, and I'll give you real estate, and that's a fair exchange. I also loan people money. Here's a loan. I lend you some money to go buy a piece of property, and instead of paying me back cash, how about you pay me back in services? That's a great trade. Right? And so there's all kinds of ways to barter, and my company really excels at using real estate equities to acquire other real estate equities. It's called equity marketing or equity exchanging. There's a lot of great things. For example, you might be very resource rich, either your time or your skill or your knowledge, or physically you have equity on your balance sheet that's illiquid, like you've got equity in a property, maybe you've got some notes or personal property. You know, I would love to take personal property to buy a house. I own a home building company. If someone to me said, David, here's a free and clear car or a free and clear RV, would you take this RV as the down payment on a house? Absolutely I would, in a heartbeat, right? So when you learn to accept other things other than cash, first of all, you do more business than everyone else, and the second is you're getting skills that are going to help you survive in a different economy. Because, for example, in other historical examples of hyperinflation, prices were doubling every 5 to 6 days. In some cases, you know, every 2 days, prices doubled. You know, you would go into a restaurant, sit down, and the price would be one thing, and by the time you paid your bill, literally the price had gone up during that time that you sat down. And so if you're stuck exchanging value through currency, you're going to be taxed the highest, and you're going to be most vulnerable to inflation. So if you ever want to do an exchange, let me know. And I love doing what's called a 3-way exchange, you know, or a multiple-way exchange, where, for example, I'm doing a transaction now where party 1 has some land, party 2 has a commercial property, and party 3 has some houses. But instead of trading 1-to-1, we all decided to pass the resource to the right. so that everyone got what they wanted, and they gave up something different than what they received. And so it was a circle rather than a line, one-to-one. That's a really cool multi-way exchange. And there's a lot of technology out there that's being developed to make multi-way exchanging even more feasible to do. Also really encourage you, reduce your dependence on things that are rising rapidly in price. For example, I moved from a very commuting dependent area. I used to live on an island in the San Francisco Bay, and the nearest shopping center was about a 15-minute drive to go get groceries. I had to drive 15 minutes each way. That was consuming a lot of gasoline. Not only was that not environmentally friendly, but it was expensive. And then I moved to a walking-friendly environment. I can literally walk to every restaurant and theater and grocery store and marina, anything that I want, I can walk to. And we went from spending a lot of money on gasoline to we might not use a car for a whole week, right? The other thing is food is going to be very dependent on the price of oil. So maybe consider planting a garden. You know, I certainly in our world we planted an herb garden because herbs are very expensive relative to the simplicity and how much space they take to grow. Imported things are going to go up in value a lot. If you've got a business that's doing manufacturing, this could be your time. You know, if you thought about getting into the clothing manufacturing business, well, probably the last 30 years have really sucked for you because of imports and competition from imports. But with oil price going up, with our currency devaluing against other world currencies, then it's going to make other things more expensive to import, and therefore you could potentially capitalize on that. I also like buying goods rising less rapidly in price. For example, housing. Right now, we've got a housing is very unpopular. Real estate in general is very unpopular. Cap rates are high. For a buyer, you want to buy a high cap rate. That means that there's a high rate of return relative to what you pay for the property. As a seller, you want to pay for a low cap rate. So right now, inflation is looming. We all agreed at the beginning of the call that inflation is looming, but it hasn't really hit yet. I mean, it's hitting in some commodities, but it hasn't definitely hit in housing or in real estate. So if you could buy something that was a durable, that had utilitarian value, that you could borrow the money at a fixed interest rate to buy, and it produced income, and it had tax benefits, and you could buy it when no one wanted to own it, well, that's right now, then that's a good thing. And then at some point in the future, when people say, holy moly, what happened? This inflation thing snuck up on me. I need to get into something that is, you know, durable and is protecting me from inflation, that I can borrow the money at a fixed interest rate. All those great benefits of real estate, when people figure out that they need to own real estate to protect their assets, it's going to drive cap rates down. There's going to be more buyers for the limited scarce resource of real estate, and people are going to need to pull their money out of paper-based assets and get into fixed commodity-based assets, and real estate investors are going to really benefit from that through what's called cap rate compression. The rent could stay the same, but if there are more investors willing to pay a higher price for that same income stream, then the price of the real estate goes up, and you benefit from it. How prepared are you for a hyperinflation event? So 70% of you have made some good decisions, but you're still in the time to prepare for inflation. And for those 30% of you that have a lot of debt and a lot of real estate, and you've got some dividends produced from real estate, congratulations. So, you know, we've got some savvy people on the call, and really, you know, to top it off. So those are my two action items, but the two more are build good support teams now and be a good lifelong learner. You know, the tragedy that happened, hopefully the people are learning that the time to learn how to operate a lifeboat is not when the ship is sinking. And, you know, it's very sad that there were a lot of people hurt, and there were people who lost their lives because they waited for a tragedy to occur before they prepared for the event. And, you know, how sad that the lifeboat drill was the next day after this event. You know, how sad for you if you know that hyperinflation is coming and you don't prepare for it until it's too late. So there's a lot of talk about real estate market cycles going up and down. Generally, prices go up, prices go down over time. When you're at a recession, that's where people want to buy, is at the bottom of the cycle. I don't know where we are in the cycle, but typically recreational investors shop at the top of those cycles, and professional investors buy in the trough. So whether we're at the left side of the trough and we have more downward price momentum to go before we have an upward tick, or whether we've already hit bottom and coming up, nobody really knows. But all I know with absolute certainty is that we are very far off of a market peak. We're somewhere in that trough, which means this is a great time to stock up on your real estate investment assets. If you had a great time, if you learned something, if this was valuable to you, if it was worth your time to be here, some great ways to say thank you for this free event. The first, come by my Facebook page, click like. Second is please forward my newsletter to someone that you think would benefit from the information. And with that, you have a great day.